So if I'm reading correctly, the summary of what happened to the market, it was down 31% today, but the circuit breaker should have tripped at 10%. Now, they don't tell us in this Excel file that you can download or the table that's online that's, I mean, it just says 10%.
What's going on, everyone? Welcome back to the channel. Today we're diving into something that has the precious metals community absolutely shaken right now. Robert Cates from the Freedom Report just dropped his analysis on Friday's catastrophic silver crash. And when I say catastrophic, I mean a 31% intraday collapse that he's calling the biggest dollar drop in silver since 1974. But here's what makes this even more alarming. He's claiming the CME's circuit breakers, which are supposed to halt trading at a 10% decline, mysteriously never activated. You're going to want to stick around for this entire breakdown because the evidence he presents about options, expiration timing, and institutional positioning is genuinely disturbing. And hey, or drop a comment below letting me know where you're tuning in from. I love seeing this global community come together around precious metals. All right, let's jump straight into Robert's breakdown and see what really happened on that Friday bloodbath.
And we've kind of rallied a bit back, but where are we right now, do you think?
Well, it was interesting. I was asked this question on the Citizens for Sound Money channel last night and I ended up giving a 30-minute answer. So I'll try and not do that and give you a summary. On Friday, we had big drops in both silver and gold. And according to what I find publicly, silver was down 36% on Friday. Intraday, meaning before the close, and it rose a little bit to be down 31%. And last night when I was looking at the statistics for the trading, and I looked at how much contract activity there was over 300,000 contracts of 5,000 ounce silver. So on Friday, there was 1.5 billion ounces of paper silver traded. Annual output of silver from the mines in the marketplace is 819 million ounces. So it was about a 1.7, 1.8x dump of, basically a dump onto the silver derivative market, yearly annual production, which I've never seen that much in any given day. I mean, there's a lot of activity in these markets. They're leveraged derivative markets, but that's a lot. And in gold, it was about half of annual production was done in a day. And so both gold and silver had a really bad down day. And it's interesting as you go through and look at it, there are circuit breakers, and I did look this up because there have been some comments by different analysts, and I've been talking to it with other analysts that I know as well that analyze these markets. And according to the CME Group, and I just downloaded this from their website, silver futures have a special price fluctuation limit and daily price limits of 10%. So I anticipate that as I'm reading from the CME Group's website, I mean, it looks as though that they have a circuit breaker. They call it the circuit breaker and daily price limit changes for CBOT interest rate, FX, and metals futures and options. And so that includes the futures prices, which determine, the prices that we see every day on the spot market. Those are determined on the futures market here in the US. And it's supposed to be 10%. So if I'm reading correctly, the summary of what happened to the market, it was down 31% today, but the circuit breaker should have tripped at 10%. Now, they don't tell us in this Excel file that you can download or the table that's online that's, I mean, it just says 10% a dynamically calculated reference price daily, and it's a daily price limit. So that would seem to indicate that after about 10%, they would have stopped trading. Much like you have a downside circuit breaker on the stock market, if Apple stock goes down a certain percentage, or if you see an index go down a certain percentage, a lot of times the stock market will stop trading to stop a slide. And the reason that is, Elijah, is because on all of these markets, whether it's the stock market or Forex or metals, futures, and commodities, there are algorithmic trading programs developed by all the main brokerage houses and banks and big participants, market makers. So that, when you have some sort of price decline or increase, a lot of times those algorithms, those software programs that run on the trading platforms will make a move based on that. So for example, if silver's falling 5%, a lot of times that triggers somebody else selling, especially if they were long, because they don't want to take a loss. And that happens in a lot of these markets. And that is why the circuit breakers were developed originally for the stock market years ago and now exist for the commodities markets, is that, when you have a big free fall in price, these circuit breakers would stop it, because these are leverage markets. You have a lot of small players, but you also have big concentrated players in the market. And if these big concentrated players or the bigger players are using these automated trading programs that all get triggered to one side, you could end up really killing off a position of a smaller player. And so on June 2nd of 2025, the CME Group had instituted these new circuit breaker and daily price limit changes. And apparently it's 10% in silver.
Okay, this is absolutely wild. When Robert mentioned that on Friday, there was 1.5 billion ounces of paper silver traded. An annual mine output is only 819 million ounces. You need to understand what that means. They traded nearly twice the entire yearly global production in a single day. I've been analyzing precious metals markets for years, and I have never seen derivative volumes at that scale. This wasn't normal market activity. This was something else entirely. And here's where it gets even more suspicious. He said this: it was down 31% today, but the circuit breaker should have tripped at 10%. Let me break down why this matters. The CME Group, the exchange where these futures trade, has explicit rules. They publish circuit breaker protocols specifically designed to halt trading when metals drop 10% in a day. These safeguards exist to prevent algorithmic cascade sell-offs from destroying smaller traders. So the question everyone should be asking is, why didn't they activate? Because when he explained how algorithmic trading works, he said this: if silver's falling 5%, a lot of times that triggers somebody else selling, especially if they were long because they don't want to take a loss. That's exactly what these circuit breakers are supposed to prevent. Computer programs see price drops, they automatically trigger more selling, which triggers more algorithms, and you get a death spiral. That's why regulators created the 10% halt rule in the first place. But on this particular Friday, with silver down 31%, nothing stopped it. The CME and CFTC have some serious explaining to do.
And if I look at gold, the gold is, well, it doesn't have one. There's one in silver. I don't see one for gold or micro gold. If I look at both silver and micro silver, it's 10%, and E-mini silver, and on the futures only, not on the options. You also have it on copper futures. You have it on aluminum futures. Oh, you do have it on gold futures, and it's all 10%. So pretty much across the board on metals, 10% on the major traded items. Why that wasn't triggered in silver, I don't know. I think gold came under that. It wasn't 10%. Silver, I think it was. So that's the question. And then what caused it? We were talking before the show what caused it. The only news item that people are quoting and saying could have caused that cascade of sells, maybe it's a human that started it and maybe it was a computer, we don't know, was that Trump has nominated Warsh as the next Fed chairman, and that the Department of Justice is doing an investigation into Powell. And so somebody's trying to block that nomination for now until the investigation of Powell is done. And that's a little bit of news, but it's not like it's actually occurred. They haven't confirmed a new chairman. The chairman hasn't come on and stated that he's taking any given direction. Also, at the most recent Fed meeting, they're holding interest rates steady. There's expected to be some interest rate drops later in the year, not now. And the Fed has stated that given the information they're looking at, that they're not wanting to make a change in the immediate future. They want to see how employment and inflation goes, specifically employment. Now, if you look at ADP's employment numbers for this week, there was only 22,000 new jobs created. We'll get the big report, the government non-farm payroll, or what they're now calling just the jobs report, later on Friday. It typically comes out Friday. But as long as positive jobs are created, then I don't see a reason why that would have caused, and it's only 22.50. That would not cause gold to move either way, really, unless it's a major surprise. And further, if we look further into economic with the United States, last week I was looking at FactSet in terms of Q4 earnings for U.S. corporations, and with only 13% of companies reporting of the S&P 500, 70% of those 13% of companies, so roughly 9 to 10, had a bit reporting earnings surprises, and from what they thought that they would have. Those were led by the Magnificent Seven, which had about 21% earnings of the S&P 500. The other 493 companies were averaging about 4%. But we still have a lot of data to come out from Q4. But it looks as though we're going to have a positive GDP print, unless the rest of the market just is totally tanked, which we're not expecting. So positive GDP print, modest jobs numbers, not a big, surprise on jobs numbers, not a big crash on jobs numbers. The 10-year bond is still elevated above 4% last time I checked the Treasury. So and the DXY had made a slight upward move, but it's not anything to write home about. It had reversed its fall slightly, a little bit of positive movement from the dollar in the DXY index. So, I'm looking at this going, there was mixed data, and could that have caused somebody to want to go short gold or silver a bit? Sure. But would that explain the biggest price, the dollar amount fall in silver in U.S. history since, 1974 and the Commodities Act and the way that we trade silver now, not as money, but as a commodity, as an asset? No. Should it have caused, almost a $700 free fall price in gold? No. Gold was a tad less surprising because it was under 10%.
Now let's talk about what supposedly caused this crash, because the mainstream narrative doesn't add up at all. Robert mentioned the only news that day. He said this: a Fed chairman nomination and a Department of Justice investigation. And his response? That's a little bit of news, but it's not like it's actually occurred. Exactly. Think about this logically. An unconfirmed nomination and a DOJ inquiry are supposed to trigger the largest silver dollar crash in U.S. history? Come on, let's look at the actual economic data from that week. He said this: if you look at ADP's employment numbers for this week, there was only 22,000 new jobs created. Okay, so weak jobs data, but here's the thing. Weak employment typically supports precious metals prices because it increases the probability of rate cuts. The Fed was already holding rates steady and signaling potential easing later in the year. The 10-year Treasury was elevated above 4%. The DXY had barely moved. Q4 corporate earnings were showing surprises led by tech. None of this screams sell gold and silver aggressively. And Robert makes the crucial point. He said this: the biggest price dollar amount fall in silver in U.S. history since 1974 and the Commodities Act. So you're telling me that mixed economic data and an unconfirmed Fed nomination caused a historic collapse? When you actually analyze the fundamentals, modest jobs numbers, positive GDP expectations, stable interest rates, there's no rational explanation for a 31% single-day drop in silver. The economic catalyst theory falls apart under basic scrutiny. Something else was happening beneath the surface.
And we had a massive run up in gold for 2 years. So that I could just explain by saying maybe, somebody big came in and dumped a bunch of gold futures on the market. But in reality, to see that happen to silver at 31% was, to me, it's not explainable in a one-day drop. And when you look at the volumes of paper that were traded, it really looks as though there was some short covering on the futures that needed to happen. And if you look at when options expiration was at the same time on the COMEX, it was the 27th, just a few days before. So what I'm assuming was once the upside, the long options, had been met and expired, that offered an opportunity to reset the board on the price via the futures. Okay. And so I think that there was short covering. Now, if you look at the banker participation report, the most recent one from the CFTC on who trades the gold and silver options, U.S. banks are net short on gold. U.S. banks are net long by about 1,000 contracts on silver. The bullion banks are actually short on silver now, or the global banks. So you can say, maybe it was the global banks mostly that had this short positioning that need to short cover. And they probably did, because silver had run up so far from the low 20s to about $121 in the span of less than 2 years, really about a year to year and a half in that time frame, that it is quite possible somebody needed, to get out of those short positions. There's some short covering needed to occur. And so I think it more had to do not with supply and demand, not because we had found a bunch of more silver, not because of a Fed announcement or GDP or labor or economic reasons. It simply was the fact that whoever was in short silver didn't want to be short silver any longer. And there was a slide in the silver price and in the gold price to cover shorts right after options expiration. And I would even go far, if I'm stepping out on a branch and pure speculation, if you look at the timing of this, we had that massive run up, those options had expired. Maybe somebody made their money on options and decided to short it and bring it back down and make money on the other side in shorts. It looks to me more like financial engineering makes more sense. And the fact that the circuit breaker wasn't tripped 10% in a day, there's questions for CME Group and the CFTC, the regulator, as to why that occurred and why that 10%, based on the table I'm looking at, it's very basic 10% per day. It doesn't give any other explanation as to, was that 10% per day per trader or other provisions that needed to be met. So I think I think that the CME Group has some explaining to do, and that the CFTC needs to be the one asking those questions.
Going forward.
And this is where the real story emerges. Robert reveals the smoking gun when he analyzes the timing. He said this: if you look at when options expiration was at the same time on the COMEX, it was the 27th, just a few days before. Options expiration, let that sink in. Massive price run up into expiration, then suddenly a 31% crash right after those contracts expired. This isn't coincidence. This is positioning. Now look at who was positioned where. He said this: U.S. banks are net short on gold. U.S. banks are net long by about 1,000 contracts on silver. The bullion banks are actually short on silver now. So you've got global bullion banks heavily short on silver after it ran from the low 20s to $121 in under 2 years. They needed an exit. And what's the perfect opportunity? Right after options expiration, when long contracts are settled and cleared, you can reset the entire board. Robert's conclusion is damning. He said this: it looks to me more like financial engineering makes more sense. And honestly, when you put all the pieces together, what other explanation fits? 1.5 billion ounces of paper silver traded. Circuit breakers mysteriously didn't trigger at 10%. Options expired days before. Global banks sitting on massive short positions, and economic fundamentals that don't justify the move. This wasn't market forces responding to news. This was institutional players manipulating derivative markets to cover losing positions. The fact that the CME hasn't explained why their own circuit breaker rules were violated tells you everything you need to know. The CFTC needs to investigate this immediately, because if exchanges can just ignore their own safeguards whenever large players need to exit positions, the entire futures market loses credibility. And for those of us who actually believe in precious metals as real money and real assets, this manipulation won't last forever. The physical market will eventually overpower the paper games. So what do you guys think of this? Leave your thoughts down in the comments. Please like and subscribe, and I will see you in the next video.